There is a man in Ohio who has not paid for a single flight in 4 years. Not because he is broke, not because he is gaming some loophole that is about to get shut down. He is just using a tool that 90% of Americans carry in their wallet every single day, and almost none of them understand. Meanwhile, the average American household is carrying over $6,000 in credit card debt, paying somewhere between 20 and 29% interest every single year. That is not bad luck. That is not a broken system. That is the system working exactly as designed, just not for them. The credit card is the most powerful financial instrument a regular person can access. It is also one of the most quietly destructive. And the line between which side of that equation you land on is thinner than most people think. It is not about income. It is not about discipline in the way people usually mean it. It is about understanding the architecture of the thing before you start using it. So let us talk about that architecture. Credit cards were not invented to help you. That is just history. When Bank of America mailed out 60,000 unsolicited credit cards to residents of Fresno, California in 1958, it was not an act of generosity. It was an experiment in mass consumer debt. They called it the Bank AmeriCard. You probably know it today as Visa. The model was simple. Get the card into people's hands before they had time to think about whether they wanted it. Because the math was never about the people who paid on time. The math was about the people who did not. Here is what that math looks like today. Credit card companies earn money in two primary ways. The first is interchange fees. Every time you swipe your card, the merchant pays a small percentage, usually between 1.5% to 3%, to the card network. That is the invisible toll on every transaction you have ever made at a grocery store, a gas station, anywhere. The second way, and this is the big one, is interest. The average credit card APR in the United States right now sits around 22%. Some store cards push past 30%, and they compound monthly. So if you are carrying a balance, the interest you owe starts earning interest of its own. The debt does not grow in a straight line. It grows in a curve. That is not a detail. That is the entire business model. So how does someone actually use this against the grain? The first thing to understand is what a credit card actually is, at its most functional level. It is a 30-day zero-interest loan. If you pay the full statement balance by the due date, that is the mechanism. If you pay in full every month without exception, you are borrowing money for free. The bank is extending you credit, you are using it, and you are handing it back before they can charge you for it. Simple. And yet most people treat a credit card like a debit card with a delay. They spend, they see the balance, they pay the minimum, and they move on. That minimum payment is where it gets dangerous. Because the minimum is not designed to help you get out of debt. It is designed to keep you in it as long as possible. Here is an example. You have a $5,000 balance on a card with a 20% APR. The minimum payment is around 2% of the balance, roughly $100 a month. If you only pay the minimum, it will take you over 22 years to pay that off. You will pay more than $8,000 in interest alone. On $5,000. You will pay back almost 3 times what you borrowed. That is not a fine print footnote. That is the main event. Now let us talk about the part that is actually worth your attention. Rewards, points, cashback, sign-up bonuses. This is where the conversation usually turns into either breathless excitement or deep suspicion. Both reactions miss the point. Rewards programs are real. The value is real. But the value only flows in one direction if you are carrying a balance. If you owe the bank 22% interest per year and you are earning 1.5% cash back, you are not winning. You are not even close to breaking even. The rewards are designed to feel like a benefit. They are actually a retention mechanism. They keep you swiping on a card you should probably stop using. But if you are paying in full, consistently, automatically, every month, the math inverts. The most straightforward setup most people never bother with is this. Take every single purchase you are already going to make. Groceries, gas, subscriptions, utilities if your provider allows it. Run all of it through a rewards card. Pay the bill in full the day the statement closes or on the due date. Every dollar you were going to spend anyway now earns you something back. A 2% flat cashback card on $40,000 of annual spending, which is not an unusual number for a household, returns $800. Tax-free, for doing nothing different. That is not a hustle. That is just using the tool correctly. The sign-up bonus is the other lever that most people either ignore or misuse. Premium travel cards routinely offer 60 to 100,000 point bonuses for hitting a spending threshold in the first 3 months, usually $3,000 to $4,000. For someone who was going to spend that money anyway, on rent, on groceries, on everyday expenses, the bonus is essentially free. At the right redemption value, 60,000 Chase Ultimate Rewards points can be worth anywhere from $600 to $1,200 in travel. Sometimes more, if you know which partners to transfer to. But here's the thing nobody tells you about sign-up bonuses. The banks are counting on something. They are counting on the fact that most people who open a new card for the bonus will keep using the card after the bonus posts. They will run up a balance. They will forget to pay in full. The bonus is a customer acquisition cost. A calculated bet that the interest revenue over your lifetime as a customer will dwarf whatever they gave you up front. If you take the bonus and leave, or if you continue using the card but never carry a balance, you have flipped the bet. That is the game. Credit score is the third pillar, and it is the one with the longest tail. Your FICO score is not just a number that tells you whether you can get a credit card. It is a number that affects the interest rate on your mortgage. It affects your car insurance premium in most states. In some cases, it shows up in background checks for employment. A difference of 40 points on a home loan can cost you tens of thousands of dollars over the life of the loan. Credit cards, used correctly, are the fastest and most accessible way to build credit. Two things matter more than anything else: payment history, which is 35% of your score, and credit utilization, which is 30%. Utilization is the ratio of what you owe versus what your credit limit is. The general guidance is to stay below 30%. The people with the highest scores tend to stay below 10. This is where the system reveals a quiet irony. The people who need credit the most, who are newer to the system, who have lower incomes, who cannot absorb a bad rate, are the people who get the worst terms. The system rewards the people who already demonstrate they do not need it. You cannot build a strong credit profile without using credit, and you cannot use credit without understanding the thing well enough to not get trapped by it. There is a version of this conversation that ends with a simple list of tips. Pay on time. Do not overspend. Use autopay. And those things are true, but they are also the surface layer. The people who use credit cards like a genuine financial asset are doing something slightly different. They are treating the card as infrastructure, not as spending permission. The distinction matters. When a credit card feels like money you have, that psychological framing is where the trouble starts. Research on consumer behavior going back decades shows that people consistently spend more when paying with credit than with cash. The friction is gone. The pain of payment, which behavioral economists have actually studied and named, is reduced. Tapping a card does not feel like losing something. But it is. The pro move is to set a hard rule. Never charge something to a credit card that is not already accounted for in your actual cash budget. The card is the vehicle. Your checking account is the source of truth. If the money is not in the account, the purchase does not happen. Auto-pay the full balance the moment the statement closes. That single habit, full balance, every month, automated, separates the people building points and credit and cash back from the people funding bank profits. Here is the uncomfortable larger picture. The credit card industry collected over $130 billion in interest and fees from American consumers in a single recent year. That number is not a side effect. It is the intended outcome. The product is not the card. The product is the revolving debt. The card is just the delivery mechanism. And the system is very specifically designed for people who think they are in control, not for people who are obviously reckless. The catastrophic spender blows through the limit and stops. The more profitable customer is the responsible person who carries a modest balance, pays more than the minimum, believes they are being financially responsible, and slowly pays the bank a fortune in interest over 10 or 15 years without ever fully realizing what is happening. That is the customer the industry has optimized for, the almost disciplined consumer. So the question is not whether you should use a credit card. The question is whether you understand what you are actually interacting with when you do. Because the same instrument that built someone's down payment through cashback and points, that same card with the same rewards issued by the same bank, is the instrument that extended someone else's financial stress for a decade. The card does not know the difference. The bank does not care about the difference. The only variable that changes the outcome is whether you understand the mechanism clearly enough to use it without being used by it. That man in Ohio with 4 years of free flights, he is not special. He is not working harder. He just read the terms. The question worth sitting with is this: how many of the financial tools you are using right now were you handed before you fully understood what they were designed to do? If this changed the way you think about something you carry in your wallet every day, the best thing you can do is share it with someone who needs to hear it, not as advice, just as information. Because most people are never going to go looking for this on their own. Like the video if it earned it. Leave a comment with the one thing that hit different, whether that is the minimum payment math, the sign-up bonus play, or something else entirely. Reading those actually matters. And if you want more of this, no fluff, no hype, just the architecture of how money actually works, subscribe. There is a lot more of this coming.